you know you are able to do it. That's the way you do the 52 weeks. Some people do monthly. I do monthly. So if you want to do it monthly, if you want to add more than the $1, you could add more. You treat that as it is a challenge. You could even challenge members of your family or friends. Say, if you come up with $1,000, I'll pay $50 on it, and choose that challenge. I usually challenge my family members and my clientels. That I said, okay, I tell you what, if you raise $1,000 within this certain time, I will give you 30% of that, something like that. I will do. So make it as a challenge. Another thing that I do is called a susu. Some people call it throw box. Some people call it throw hand. It's a Caribbean phrase, and I don't know what they call it in the US, but what it is basically a group of people come together and they decide that, okay, we all want to raise a $2,000 or maybe $3,000, whatever, and they decide on who gets the money each month. And then they decide who is going to be the treasurer or the person that keeps the money. So every month, everybody pay $100 or $200 into it. And every month, that person that is chosen for that month, it gets the money and it goes around until everyone gets their money. And then that will be the end of it. And then they could start up another box or a susu. It all depends on the group and how they want to go about it. But in that group, you must be dedicated. Because if you take the money and run, it's not good. Or you're not paying the money on time, it's not good. So you be fair to people when you're doing something like that. But usually when you do something like that, you want to work with a group of trustworthy people in order to do something like that. So that's what we call it, a susu. I don't know what you call it here. That's another way to raise money for emergency. Or with me, I personally take that money and I dump it into my other saving account. Another thing number 4 would be the 401k. 401k I used to use when I was working in the corporate world, but I'm no longer in the corporate world. The 401k is that money taken from your paycheck before you even get that, before taxes, and your employer match that amount, and they put that money away for you, so you could at the end of time when you no longer work for that company, you could take that money and use it however you want. You could stop it. You could do anything what you want. But if you're stopping it and doing all that stuff, you're not really saving. So if you're doing a 401k, that's another way to save money. Me personally, I still have my 401k. I roll my 401k into my Roth IRA, which I will explain that to you in a few minutes. So that's what I do with the 401k. That's another way to save money. You put a certain amount, your employer match it. The next one is the Roth IRA. The Roth IRA is money that you put into some kind of investment for retirement, and it's tax-free. So when you do get the money back at your retirement age, it comes out tax-free. And if you heard me mention the 401k, that is not tax-free. So that portion of your Roth IRA will be taxed if you do it that way. So just so you know, which that's another story for another day, what I will explain to you later on. And the last thing that I do is I call it pay yourself every dime 1%. And when I do something like that, that's basically when I do something like that is for every money I get, I take 1% out or 10%. So if I get $1, I'm taking putting away a dime or whatever. I just pay myself something out of it, and that way it helps me save money. You keep doing that at the end of the year, you will find that you have money. You may think $1, I pay 50 cents. Yes, every dime you make, you pay yourself, and before you know it, you have money saved. This is why I strongly believe in educating others on how to build their own bank, be self-sufficient with a guaranteed wealth for their family versus being a loaner to the local bank. Do you know that in our lifetime, most of us will touch $1.5 million, which we will never see because the harder you work to get ahead and build your own income, the more debt, interest, and tax you pay, leaving you little to no retirement saving. In order to maximize guaranteed wealth for your family, we will need to find a way to minimize your debt, interest, and tax you pay. By learning the discipline of paying yourself first and tax deferring saving, you will be able to build your own bank. Let's take a look of how much you have earned minus how much you have saved.
Let's say your average annual income is $33,706 and you have earned the same amount for 5 years. Your equal amount earned would be $168,530. Let me be generous and say you have saved $8,055 over the period of 5 years. By dividing D by C, you would have saved 0.5% from the $168,530 in a period of 5 years. Now you do the math and let me know if you are happy with what you're seeing. Okay, guys, this brings us to the end. Remember, it's not what you earn, it's what you keep. Put yourself at the head of the line. Treat your saving like any other recurring bill that you must pay every month. Dedicate an appropriate amount from your paycheck and set it aside. Change your mindset and make a commitment to pay yourself first.